Hey everybody, it's Mike from Orderflows and welcome to today's video. Today is Saturday, January 14th, and I want to get this video out there because Saturdays is a nice day to catch up on your studies of the markets, and try to look at the order flow footprint and figure out some of the things that you should be keying in on when you're watching a footprint chart. And again, I'm not doing these videos to give you trades. I'm doing it to get you to think so you could make those decisions yourself. So when you're looking at a footprint, when you're trading by yourself, because I'm not going to be trading standing behind you telling you what to look for, I want to teach you what to look for. So if you've been liking these videos, I've been trying to be pretty active and get them up about once a day. Be sure to subscribe to the channel so when I do post a new video, you'll get a notification. And if you find you get anything out of it, by all means, like the video. All right, so what I want to talk about today is trading, markets that aren't as popular as, say, the equity indices, right? The MNQ or the NQ or YM, the mini Dow ES or MES, because there's a lot of other markets out there. And unfortunately, though, with these other markets, they don't have that volume that you see in the equity indices. And today I'll be talking about 5 years. I'll be talking about one of the grain markets. So first in the 5 years, because 5 years is one of these markets that I've always told people in the past since I started working with retail traders, almost 10 years ago, as a market that for people to get experience. Right now, now there's all these funded programs, and say what you want about them. I have my own opinions. Having skin in the game, so to speak, is the best way to basically hone your skills, so to speak, right? I mean, it's one thing to paper trade and be in a try to get funded, that way. But when you have your own money on the line, it should sharpen your thinking skills. All right. And one of the markets I used to recommend to people was the 5 years, the ZF, the 5-year notes. And obviously the main reason was because it was had a very low margin. It was only like $250 a contract at AMP. It used to be. I don't know what it is now, but it trades in quarter ticks. So a tick is like $7.81, and it's not a market that you're going to get these big price swings, 20 ticks in 30 seconds as you would in say the ES or MES. So, and it's liquid. So if you need to exit the position, there's liquidity there, at least at either on the bid and the offer or the next bid and the offer. You've seen sometimes in these equity indices, you try to get out, you're filled 2 or 3, 4 ticks worse than, when you hit the sell button or the buy button. But the problem with that is if you're looking at a time-based chart, you get a lot of this, right? Which is hard to analyze in the order flow, where it's just basically trading one price, right? The bid and the offer, more or less, for extended periods of time. And if you're trying to analyze a footprint chart, ideally you want to see some movement in the market. And if you're getting, some movement, but it's taking you 20 minutes to get a little bit of movement on a minute, looking at a minute-based chart isn't going to be very effective. And for interest rates, I've always recommended a 4-range chart, even a 5 range, or again, even a 3 range. But you want to have some movement because you want to be understanding what's happening in the order flow as the markets move. Now, there are strategies for markets that aren't moving, but those strategies are more for markets that aren't moving, that are trading decent volume above and below the bids and the offer, not literally just trading one price. So if you go to a 3 or 4 or 5 range chart, you're going to start to see some movement. So I'll just pull up a 3-range chart. But again, a 3-range chart is about as low as I would go. Okay. Excuse me. So what I'm looking for is basically the same thing as I would be looking for on an E-mini, MES, crude oil, etc. I'd be looking for the ratios and divergences, right? Like you have here, right? The two blue and gold arrows, right? I know this is a divergence. It's a new equal low with positive delta, and I've got my bullish ratio here, right? I see the market go up, and it's running into some resistance up in here. I read the delta the same way. I see the positive, market coming down. Delta is getting a little bit weaker, 22700, 300, 49, 177, 687, and the market goes up a little bit, but it runs into supply and the market drops back down. Here's another divergence here. All right, I love prominent point of controls. Okay, and in this case, this is a point of control on the extremes, means a red candle with the point of control up near the top. You got the bearish ratio. So I know that theoretically there is some stopping volume in this bar, as the market's moving down. That's what I want to know, right? And again, whether I'm looking at an E-mini chart or a 5-year chart, I'm looking for the same things, okay? Because they're going to manifest themselves, whether it's E-mini or 5-year, 10-year, crude oil. And again, I see here another bearish prominent point of control. And again, it's not like just because you're looking at a different market, you got to take everything you know about order flow and throw it out the window. No, you're looking for the exact same things. Here's a ratio here in the divergence here. Starts to go up, then it fails. But then you get the same sort of setup coming in here again, and then finally you get the move. Okay, now this is a 5-year. Now, 5 years trade decent volume. You can see, each bars are trading, several thousand contracts, right? And in the bars, these price levels are trading, several hundred contracts. But what about markets that don't trade a lot of volume, but sort of move the same way? A good example is soybean meal, right? Now, again, I'm not advocating people go out there, start, trading meal or trading 5 years, but I do know that there are other traders out there that are interested in some of these other markets beyond, because they're just burnt out with MES because it just moves around a lot. And the nice thing about the slower moving markets that don't trade all that liquidity is they tend to follow order flow better. And the reason for that is because they're following supply and demand, because the people that are trading soybean meal, people that are trading 5-year notes have a reason to. They're not necessarily speculating, although there is speculators in those markets, but the overwhelming amount of trading is coming from people that are involved in the process, I'll say the farmers, but traders that are buying or selling soybean meal based on their business, right? That's what their business revolves around, or people trading 5 years, they're trading the whole yield curve, or they're hedging something, things like that. It's not just people taking speculative positions. So this is the soy meal. Okay, now let's take a look at a minute-based chart. Did I hit that? Okay, just give it a second here to come up. Mouse is acting up here. Okay, so let's just go back now. Soybean meal, there is an overnight session, but the main session opens up at 8:30 in the morning. Where are we here? Scroll back. Okay, so here, right, 7:45, then reopens at 8:30. This is the main session. And now you're seeing, look at the volumes here, right? So this is a 1-minute chart, and right after the open, that's where you're going to get a lot of the volume, 500, 600, but then everything else during the day, it's pretty tame. There are some bars with some big volume, 453, but everything else, 96, 90, 72, 61, this is 199, a couple bars with 200. But in a market like this, again, same things I'm going to be looking at. How are we trading relative to the low or the high, or if we're coming in at a swing high, where's the prominent point of controls coming in here, right, which is acting as support. I can see the volume coming in here, 48 on the bid, 103.52, right? So there's big liquidity here, right? And you see the market rally up from that area. You test it once, twice, 3 times to an area where you're getting some stopping volume, 126 on the offer. This is a bearish prominent point of control. So I got bullish prominent point of controls here, followed by a bearish one. What do I think is going to happen? Well, I think it's probably going to drop, right? And you can see it starts to drop down. Okay, coming back down. Again, I'm looking for, areas of where a market can turn based on where the volume is being traded. Okay, see, sort of comes back up here as a bullish prominent point of control. Then it's coming back down into the low of the day. Okay, makes a new low. Some heavy volume here, 209. Okay, did it stop the move? Not really. Came down, made a lower low by 2 ticks, then started rallying back up a little bit, but nothing really to get too excited about. You do have a divergence here. You got a 0 print here, which technically is a ratio, but doesn't go anywhere over the next couple of bars. It just sort of goes sideways and then takes out that low, takes out the low again by a tick. Again, nothing overly bearish coming in here, but not, again, nothing overly bullish coming in here off this low. Okay, then you're starting to see some interesting things here in the order flow. It's just going sideways, but then again, you're seeing this volume coming in here like you saw earlier, 53.85. Right? These are two bullish prominent point of controls. That's what this magenta line is, just like over here earlier, this area, right? The 48, the 103, the 52, and you got a bit of a rally. And people say, well, you know, it's soy meal. Yeah, it's soy meal. You know, if you take it from 42.5 up to 43.5, it's $100 move basically, which is, you know, I don't know, for some people, I guess, you know, they'll scoff at that, but that's a decent move to be had. You know, then again, you see them testing these two areas right in here, 479.80, and again, it goes up from around, you know, 480.50 up to 481.50. It's another $100 move. Then it comes back down, right? You got your bearish prominent point of control there, and it comes back down into these lows. Starts making new lows. You got a divergence, no reason to buy it here. Got a divergence, not really any reason to be buying it down here either, because you don't have the bullish ratios. But this is where it gets interesting, right? Since we're talking about volume, right? This is by looking at these markets that don't trade a lot of volume, you really get to key in on the volume, okay? Which is a bit different than the E-minis because you're so used to heavy volume. But if you're trading a market that doesn't trade a lot of volume, it really stands out a heck of a lot more. And what do I mean is, look at this bar. So you made a new low here. Then this bar, it's got a big negative delta. It's a green candle. Well, Mike, you got a big negative delta. Shouldn't the market be going down? Well, why is it happening? This is what using a footprint allows you to do, is allows you to look at the volume and where it's transacting. Well, it's transacting on the bid, 477.5 bid. So what happens? Market's selling off, and then it got down to 476.90, and then buyers are coming into the market, right? Saying, hey, you know what? We just dropped from 482 down to 477. Yeah, I like that. I'll be buyer here at 477.40 or 477.5. Yeah, they're coming in. 102.26 starts ticking up a little bit. 172, another big negative delta, right? Minus 105. Right? You didn't get these two big negative deltas, but the bars are green. The market's going up. Why? It's because you have support coming into the market. They're talking about market generated support. This is a perfect example. Then the market dips back down. Dips back down to where? 477.30, which is the low of this bar, but down to that 77.40 where you traded 102 earlier. Now you transact another 71 contracts there. So imagine you're at your low of the day. You're seeing nice supportive buying coming in, 100, 70, 172. What is that? 100, 200 when you add these two together, the 26 and 71, 300, you know, close to 400 contracts going through here at, you know, between 77.80 and 77.40. Okay, buy it, all right? Because what's your risk? Well, the risk is just down here at 690, the low, because I know that buyers are stepping in. Actually, your risk would just be, you know, somewhere down in here around 77. You don't even need to go below the low. And, you know, you're going to be looking for that move back up, okay? So if you're looking for a move back up, this is the thing. Don't get married to the trade. You want it to happen sooner rather than later, because now you know buyers are attracted to the market and they're giving you some support. Okay, so if you're getting long, you know, call it somewhere in here, 77.60, just, you know, rough. Okay, and it starts to move up. 77.60 gets up to almost, well, I'll say 78.60, just traded one, but it was trading up in here around 78.30. And this is where it comes into watching your trade, managing your trade. Okay, you know, your stop is down here at 77.10, so about a 5-tick stop. And it's just sort of hanging around. Okay, again, I like the moves to happen sooner rather than later. Okay, so you know, it's trading 78.70. And it's just hanging around here. It comes down here, 78, gets some supportive buying coming in. Where is the move? All right, you're getting long in here, 10:37, 10:38 in the morning. It's already pushing 11 o'clock. It's just sort of hanging around here. That's not a good sign. You're in a trade for a half hour, you're still in the money, which is good, but it's not really paying you. That's where you have to start saying, okay, what's going on? Do I want to stay in the trade or not? Okay, and if you stay in the trade, comes back down to your entry price, pops back up. Again, this market is telling you, book it, take your profits, get out. Now you're starting to see some bearish things come in here in the order flow. Bearish prominent point of control, another bearish prominent point of control. Does come back up, right? It looks like, oh, you know, and this is the problem that a lot of traders face. They hold on to a trade too long. Because, you know, the reason for getting into a trade, it has a lifespan. Okay, it's not something that you should be looking to carry on forever. And then this is what happens, right? You get into a trade an hour ago, and it's just sort of hanging around in the money, and then it looks like it's going to start taking off, right? Oh, I got my big supportive buying coming in, 111 trading on the bid. Okay, and it's coming in just after an area where you had some resistance. Okay, because remember here, 25.40, and this is coming in at the same level, so it cleared it and it's gone bid over at 479. And you're thinking, this is it. You know, you're rubbing your hands together. Now, you'd been in the trade for about an hour. What happens? It goes up a little bit, 79, 479.70, just sort of hangs around, and it just keeps hanging around that area. I mean, at some point, you got to be thinking, I'm not getting paid on this trade. Right? I mean, you are, because you're in the money. So you're like, you know, $100 into the trade, close to $200 at this point, because your entry is, you know, 77.60. You know, we're trading 79. You know, let's call it 79 here. So it's about, you know, $150. But if this is the problem, is traders tend to hold it too long, and then this starts to happen. Boom, and it comes down to your stop out. So you're risking 5 ticks on the trade, but you're 15 ticks in the money for a good portion of that trade. Now, you know, people will make the argument, well, you can trail your stop up. Okay, but it's a slow moving market. You probably would have gotten stopped out at, you know, maybe broke even, as opposed to just realizing, hey, you know what, this trade, the move hasn't happened. Because if you're getting long back here off this big supportive buying, you want to see the market build off that. You want to see the market, you want to see more buying coming in to move this higher. And if instead you don't see any of that anymore, chances are that move's not going to happen. Okay, so, you know, on this video for there, so if you could understand, right, the things you're looking at in the order flow, it's the same thing, whether it's a soybean meal, whether it's 5 years, whether it's MES, whether it's CL, euro currency, you know, but sometimes by going and watching smaller markets, I don't say slower moving markets, but smaller markets, this is a 1 minute chart, you can key in on certain aspects of the order flow better than, you know, when you're looking at something like, there's my E-mini footprint here. Yeah, that's not the E-mini footprint. I got them all over the place here. I got a lot of charts I'm testing stuff on. Where it's just, you're just so numb to the numbers, where it's just, you know, hundreds of contracts at each price level. You're just numb to it. But if you go and you start watching it on a slower moving market, you really start to become sensitive on what to look for in the market. Okay, so again, thanks for the time watching this video. I hope you got something useful out of it, and have a great rest of your weekend. Bye-bye.